Welcome to Section 7 of ASC 505 Equity Training. This final section brings everything together: required disclosures under GAAP, key differences between GAAP and IFRS, the most common mistakes teams make, and what auditors expect to see. By the end of this section, you will be fully equipped to close the books and present equity with confidence. By the end of this section, you will be able to identify all required equity disclosures under ASC 505, distinguish how US GAAP and IFRS handle equity differently, recognize and prevent the 7 most common equity mistakes, describe what auditors expect from your support package, and apply the period-end checklist to ensure equity close is complete and defensible. ASC 505 requires specific disclosures for every class of stock. You must disclose the number of authorized, issued, and outstanding shares. You must state par value and describe the rights and preferences, including voting rights, dividend rights, and liquidation preference. For preferred stock, add the dividend rate, whether dividends are cumulative or non-cumulative, conversion terms, call prices, and the liquidation preference amount. If subscription receivables exist, disclose the subscription terms as well. Beyond share counts, you need to disclose dividend restrictions. If a debt covenant limits the company's ability to pay dividends, that restriction must appear in the notes. Cumulative preferred dividends in arrears, amounts owed but not yet declared, require disclosure even though no liability exists until declaration. Treasury stock activity for the period must be summarized, including purchases, reissuances, and retirements. Finally, all AOCI components and any reclassifications from AOCI into earnings need their own disclosure. Under US GAAP, the equity section has 5 standard components. Common stock is recorded at par value, par times shares issued. A PIC captures everything received above par on stock issuance. Retained earnings accumulates net income over time less all dividends paid. AOCI holds unrealized gains and losses that bypass the income statement. Think pension adjustments, hedging gains, and FS security changes. Treasury stock is deducted from equity at cost using the cost method, which is the most common approach. IFRS uses the same economic structure as GAAP, but with different labels and some meaningful differences. Under IAS 1 and IAS 32, the account called a PIC becomes share premium. Many IFRS jurisdictions have eliminated par value altogether. Where par value does not apply, all proceeds from a share issuance go into a single share capital account with no split required. Treasury shares are deducted from equity under IFRS, just as under GAAP. IAS 1 requires a full statement of changes in equity, the same roll-forward GAAP requires. The biggest structural difference between GAAP and IFRS equity is the mezzanine. Under SEC guidance for US GAAP, instruments that are redeemable, such as preferred stock that must be or can be redeemed at the holder's option, are presented in a separate mezzanine section between total liabilities and permanent equity. IFRS under IAS 32 has no mezzanine category. Classification is binary. An instrument is either a financial liability or equity. What GAAP presents in mezzanine will generally be a full liability under IFRS, which can significantly change reported leverage ratios. For cash dividends, both GAAP and IFRS recognize the liability on declaration date. IAS 10 is explicit that dividends declared after the balance sheet date are non-adjusting subsequent events. They are disclosed in the notes but not accrued, which is consistent with GAAP practice. For stock dividends, GAAP distinguishes small dividends at fair value and large dividends at par. IFRS calls these bonus share issues, and the fair value versus par distinction is less significant because par value is often absent. Subscription receivables are contra equity under both frameworks. 4 of the 7 most common mistakes involve recording items in the wrong place. First, recording a gain or loss on treasury stock reissuance in P&L treasury stock transactions. Never touch the income statement. Gains go to a PIC and shortfalls come from a PIC first, then retained earnings. Second, recording dividends as an expense. Dividends are distributions to owners, not expenses. Debit retained earnings, credit dividends payable. Third, showing a subscription receivable as an asset rather than contra equity. Fourth, failing to split common stock issuance between par value and a PIC. 3 more common mistakes involve measurement and mechanics. Fifth, measuring a small stock dividend at par value instead of fair value. The rule is clear. A stock dividend under 20 to 25% uses fair value, 20 to 25% and above uses par value. Sixth, recording a journal entry for a stock split. A stock split requires only a memorandum entry. You update the share count and par value per share, but there is no journal entry. Seventh, charging losses to appropriated retained earnings. Appropriations are just internal segregations. Losses go to unappropriated retained earnings or flow through the income statement, never to an appropriation account. Auditors approach equity with a documentation-first mindset. They will ask for a cap table, typically from Carta or a similar system, reconciling authorized, issued, outstanding, and treasury shares all the way to the equity subledger and the general ledger. For share issuances, they expect board resolutions, stock certificates, executed subscription agreements, and cash receipts for proceeds. Treasury stock requires brokerage confirmations for repurchases and support for any APIC credit or retained earnings impact. Dividend testing starts with board minutes, and every equity component needs a full roll forward from opening to closing balance. AOCI deserves its own documentation package. Auditors expect a roll forward of each AOCI component. Pension adjustments need actuarial work papers. CTA and hedging gains need the underlying hedging documentation and foreign currency analysis. On the controls side, your team member performs initial identification, classification, and recording, and prepares all supporting schedules. They flag unusual or borderline items to the team lead immediately. The team lead reviews all journal entries, work papers, and disclosure drafts, and escalates to the manager on any judgment-based conclusion. The manager role in equity close is a checkpoint, not a rubber stamp. Managers approve all judgment-based conclusions and significant estimates, for example, the fair value used for a small stock dividend or the classification of a redeemable instrument. Managers review and approve all financial statement disclosure language. They communicate significant accounting decisions to client management. And critically, manager sign-off is required before the financial statements are issued. The key principle is escalate early. By the time you reach issuance, there should be no surprises. The period-end checklist starts with share issuance and treasury stock. Confirm your cap table, Carta, or equivalent, is updated for every transaction in the period. Verify the share count relationship. Authorized must be greater than or equal to issued, and issued must equal outstanding plus treasury shares. Every new share issuance needs a board resolution and a signed agreement in the file. All repurchases are recorded at cost in the treasury stock account. When treasury shares are reissued above cost, the excess is credited to a PIC. Never to P&L reissuances below cost come from a PIC first, then retained earnings. The dividend portion of the checklist confirms cash dividends are recorded on declaration date. Stock dividends use the correct measurement, fair value for small, par for large, and stock splits are handled as memorandum entries only with no journal. Cumulative preferred dividends in arrears must be disclosed in the notes even if not yet declared. For retained earnings, confirm net income has been closed. Complete the full equity roll forward. Every component from opening balance through all current period transactions to closing balance, tying to the financial statements. Appropriated retained earnings accounts must show no losses charged against them. Let us close with the key takeaways from Section 7. Required disclosures under a SC 505 cover shares authorized, issued and outstanding, par values and rights, preferred terms, dividends in arrears, dividend restrictions, treasury stock activity, and AOCI components. GAAP uses a PIC and a mezzanine section for redeemable instruments. IFRS uses share premium and has no mezzanine. Treasury stock transactions and dividends never touch the income statement. Stock splits are memorandum only, and small stock dividends use fair value. Audit readiness means a complete and reconciled cap table, board resolutions for every transaction, and full roll forwards for every equity component. Thank you for completing this section on disclosures, GAAP versus IFRS, and audit readiness. Thank you for watching. Subscribe for more training from PNJ Group.